Welcome, students, to Lesson 7 from Chapter 1 of ACCA FIA FA1. Today, we're diving into an essential topic, sales tax. You're making fantastic progress, and I want you to know that we're here to make every step of this journey as smooth and as straightforward as possible. I know studying for ACCA can sometimes feel overwhelming, but don't worry, we're in this together. We're committed to breaking down every concept so it's easy to understand, guiding you through each topic, and helping you feel fully prepared and confident for your exams. We'll be right here with you, all the way to the end of the book, ensuring you not only understand the material, but are ready to excel in your exam. If you're finding these lessons helpful, please show your support by liking this video and subscribing to our channel. Your support helps us bring you more high-quality lessons, and it lets us know we're on the right path together. Let's keep pushing forward, keep learning, and let's make passing this exam our goal, one lesson at a time. Let's get started with sales tax and make this topic crystal clear. Sales tax, an in-depth explanation. Sales tax is a type of indirect tax imposed by the government on the sale of goods and services. Unlike income tax, which is paid directly to the government, sales tax is collected by businesses at the point of sale and then forwarded to the tax authorities. This process ensures that the government earns revenue each time a product or service is sold. In business, there are two primary aspects to understand about sales tax: output sales tax and input sales tax. Output sales tax. Output sales tax is the tax a business charges its customers on the sale of goods or services. Essentially, whenever a business sells a product or provides a service, it includes an extra percentage as sales tax on top of the sale price. This additional charge is known as output sales tax. Input sales tax. Input sales tax is the sales tax that a business pays when it purchases goods or services from its suppliers. When a business buys materials, equipment, or other goods and services it needs, the supplier may add sales tax to the purchase price. This tax, known as input sales tax, is paid by the business to the supplier. This input sales tax can be seen as an expense for the business, but it also has another important role. In many jurisdictions, businesses are allowed to offset the input sales tax they've paid against the output sales tax they've collected. Sales tax in the European Union, EU. Sales tax operates under a similar principle across many countries, especially within the European Union, EU. However, each EU country can set its own sales tax rate, which can differ significantly from one nation to another. This rate variation depends on the government's policy, economic needs, and priorities. For example, the UK's sales tax is known as value-added tax, VAT. The rate for VAT can vary depending on the type of product or service. Basic necessities, such as some food items, might be taxed at a lower rate or even be exempt from VAT in certain cases. Luxury goods or non-essential items might have a higher VAT rate. Each country's tax rules are unique, and the rates are applied differently depending on product categories. Reduced rates. Many countries apply reduced rates on essential goods. These can include basic foods, medical supplies, and children's clothing. The purpose is to make these essential items more affordable for consumers by reducing the tax burden. Standard rates. Standard rates apply to most goods and services, covering a broad range of products. Higher rates. Some countries apply higher tax rates to luxury goods and services, such as jewelry, fine dining, or high-end electronics. These varied rates reflect government priorities and economic policies, as they aim to make essential goods affordable while taxing non-essential, higher-end goods at a higher rate. In the EU, businesses operating across borders within member countries must navigate these varying tax rates. This means they need to be aware of the specific sales tax requirements in each country where they sell products or services. The importance of sales tax rates in business calculations. For any business, accurately calculating sales tax is essential. The amount of tax charged to customers depends directly on the applicable sales tax rate. If a business miscalculates this rate, it can lead to significant issues, such as undercollecting or overcollecting tax from customers. In an educational setting, when studying sales tax in exams, students are often given a specific tax rate to apply in examples. This allows students to practice calculating the tax and understanding its impact on sales and pricing. It's crucial to pay attention to the provided rate because different rates will yield different tax amounts. And the purpose of the exercise is to understand how sales tax calculations impact financial transactions. In business practices, even small differences in tax rates can have significant financial consequences. For example, undercharging tax. If a business accidentally charges a lower tax rate than required, it will owe the difference to the government, leading to unexpected costs. Overcharging tax. Overcharging sales tax can lead to customer dissatisfaction and potential refunds, as customers have paid more than the legal requirement. Therefore, correct application of sales tax rates is essential for compliance, financial accuracy, and customer satisfaction. Record keeping and reporting. Sales tax businesses are required to keep detailed records of the sales tax they collect and pay. Accurate record keeping is essential because it allows businesses to track their tax liabilities accurately, report the correct amounts to tax authorities, provide documentation in case of an audit. Typically, businesses will include the sales tax amount separately on invoices, making it clear to customers how much of their total payment is due to sales tax. This transparency is important for both regulatory compliance and customer awareness. For reporting purposes, businesses submit periodic tax returns detailing the total amount of sales tax they've collected, output tax, and the amount they've paid, input tax. The difference between these two amounts is what the business either pays to or receives from the government. In summary, sales tax involves multiple components and considerations for businesses. Output tax represents what is collected on sales, while input tax represents what is paid on purchases. Businesses must apply the correct rates, maintain accurate records, and report regularly to comply with legal requirements. Understanding the mechanics of sales tax ensures businesses operate smoothly and comply with government tax laws. Calculating sales tax. Sales tax is an additional amount added to the original or net price of a product. This amount is typically calculated as a percentage of the net price. Let's go through the example provided. 1. Net price of the product. Here, the net price of the product is $120. 2. Sales tax rate. The sales tax rate is given as 20%. This means that the sales tax will be 20% of the product's net price. 3. Calculating the sales tax. To calculate 20% of $120, we multiply 120 by 20 and then divide by 100 to convert the percentage into a usable figure. The calculation is as follows. Sales tax equals $120 times 20 divided by 100. This equals $24. 4. Gross price calculation. The gross price of the product is simply the net price plus the sales tax. So in this example, gross price equals $120 plus $24, which equals $144. Thus, gross price is what the customer actually pays, and it always includes the net price plus sales tax. Ver 5. Where the money goes. Purchaser pays the gross price, here, $144. Government receives the sales tax amount, here, $24. Seller retains the net price, here, $120 as revenue. 6. Reverse calculation from gross price. Sometimes you're given the gross price instead of the net price, and you need to determine the sales tax and net price from there. For example, if the gross price of a product is given as $282 and the tax rate is 20%, you can reverse the calculation. Sales tax equals gross price times 20 divided by 120. For $282, this calculation gives us $47 as the sales tax. Therefore, the net price would be gross price minus sales tax, which is $282 minus $47, resulting in $235. Part 2. The question and its solution. Now let's move on to the question. We are given two products, A and B. The gross price of product A is $705. The net price of product B is $480. The task is to determine the sales tax for each product if the sales tax rate is 20%. Solution. Let's solve for each product step by step. 1. For product A, since the gross price, the amount including sales tax, is $705, we want to calculate how much of this is the actual sales tax. Sales tax for product A equals 20 divided by 120 multiplied by 705. This calculation gives us $117.50 as the sales tax. So, the net price of product A, amount excluding sales tax, is the gross price minus sales tax. Net price equals $705 minus $117.50, which equals $587.50. 2. For product B, we are given the net price for product B, which is $480. To find the sales tax, we take 20% of the net price. Sales tax for product B equals $480 times 20 divided by 100. This gives us $96 as the sales tax. So the gross price, amount including sales tax, of product B is gross price equals net price plus sales tax, which is $480 plus $96, equaling $576. Summary of key steps for clarity. Step 1. Identify if you're given the net price or gross price. Step 2. If calculating sales tax from net price, multiply by the tax rate divided by 100. Step 3. If calculating from gross price, multiply by tax rate divided by 120 to find the sales tax. Step 4. Use the result to either add to net price for gross or subtract from gross for net. This should clarify how sales tax calculations work, regardless of whether you're starting from the net or gross price. Following this approach will help you apply the right method based on the information provided. All right, let's dive deeper into the concept of input and output sales tax and examine each part of the table with clarity, as if I'm explaining this to beginner students who are new to this topic. Understanding input and output sales tax. In any business that buys and sells goods, sales tax plays an important role. Let's break down the basic concepts first before going into the table. 1. Output sales tax. This is the tax that a business charges to customers on its sales. Think of this as the tax that a business collects when it sells a product. For example, when a store sells a product to a customer, it might add a sales tax on top of the selling price. This sales tax amount is collected by the business but does not belong to it. It belongs to the government. 2. Input sales tax. This is the tax that a business pays to its suppliers when it buys products or services. When a business purchases goods or services necessary for its operations, it also pays sales tax on these items, which goes to the government. This tax is part of the business's expenses. How these taxes are balanced. At the end of a specific period, a business compares the total output sales tax it has collected from customers with the input sales tax it has paid to suppliers. If the output sales tax is greater than the input sales tax, the business has collected more sales tax than it has paid, meaning it owes the difference to the government. Conversely, if the input sales tax is greater than the output sales tax, the business has paid more in tax than it has collected, so it is eligible for a refund from the government. Now, let's go through the table step by step. Table explanation, detailed breakdown, output tax received, input tax paid. Total treatment. This table provides two scenarios showing what happens when output and input sales taxes are compared. Let's analyze each row in detail. Row 1. When output sales tax exceeds input sales tax. Output tax received, $1,000. This means the business has collected $1,000 in sales tax from its customers through its sales transactions. This amount represents the tax on the sales the business made during a specific period. Input tax paid, $900. Here, the business paid $900 in sales tax to suppliers for its purchases. This amount represents the tax the business incurred on the goods and services it bought to run its operations. Total, $1,000. Output minus $900. Input equals $100. The total here shows the difference between what the business collected sales tax and what it paid. Since the business collected more $1,000 than it paid out $900, the result is $100. This extra $100 means that the business owes this amount to the government, as it represents additional tax collected from customers that the business hasn't spent. Treatment. Pay to government. Since the business collected more tax than it paid, this excess $100 needs to be paid to the government. The business acts as a collector on behalf of the government, so any extra amount collected in tax must be transferred to the government. Row 2. When input sales tax exceeds output sales tax. Output tax received $900. In this case, the business has collected $900 in sales tax from customers through its sales. This represents the sales tax from the products the business sold within the period. Input tax paid. Here, the business has paid $1,000 in sales tax on its purchases. This is the tax the business paid to its suppliers on the products or services it purchased. Total, $900. Output, minus $1,000. Input equals $100. The total calculation here shows that the business paid out $100 more in sales tax than it collected. This negative result, represented by 100, indicates that the business has essentially overpaid in sales tax. Treatment. Refund from government. Since the business paid more in tax, $1,000, than it collected, $900, it is eligible for a refund of $100 from the government. The government will return this difference to the business because the business has effectively covered more in tax than it collected. Key points for clarity. Balancing act. The concept of input and output tax ensures that businesses only pay sales tax on the actual profit margin they earn from sales, not on every purchase. By deducting input tax from output tax, they only pay the tax owed after accounting for business expenses. Government's role. The government receives sales tax either directly, if output exceeds input, or indirectly through refunds, if input exceeds output. This balance helps maintain fair tax payments across businesses, avoiding double taxation on the same items. End of period adjustment. Businesses usually perform this input-output tax adjustment at the end of a tax period, monthly, quarterly, etc., to ensure they either pay or receive the correct amount from the government. This thorough explanation should clarify the mechanics of input and output sales tax, ensuring you understand how and why businesses adjust their taxes based on their collected and paid amounts.